Hello traders, Chris Caprice, Second Skies, Forex.com. What is going on with the FX market? That's what we're going to be talking about in this video. I've been trading the FX market for 19 years now. I've seen everything across the board. I've seen prices that you probably didn't even know existed in certain currency pairs because they have not been there for years and years and years and years and years. I've seen it all. And what I'm seeing right now is something totally unique. It's happened in smaller versions of this before, but nothing like this before. We're at kind of this very unique turning point in history with the FX market. And this has a lot of implications for your trading and how you are going to trade it. So let's go ahead and jump into today's video. So what I want to jump into today is I'm going to show you kind of a little bit of experiment. We're going to look at these four charts right over here, euro, dollar, pound, dollar. Dollar, yen, and dollar max, three majors and a minor exotic here. So let's go ahead and bump this up here full screen. Okay, so what we're looking at here is the weekly chart on the euro US dollar. And this blue line on the bottom here, this is the ATR average true range. So the ATR, not normally an indicator I keep on my charts all the time, but it is good for kind of giving you an idea about very specific pieces of information in terms of volatility, potential targets, how to kind of set those generally. And what ATR does is generally measures the average true range based upon the time period and time frame you're using. So I've set it to a period of 4 for 4 weeks on average in a month. Some weeks trading months have 5, but we're just doing this 4 to kind of average it out. And we're on a weekly chart. So what we're looking at is the average pip volatility on the euro US dollar on a weekly chart over a month. And what do you notice? It's incredibly low. Now let's put a line here to show you where it is historically. And so there it is, about 99 to 100 pips range on a weekly average basis for every 4 weeks in a month. So think about that. Every week the euro dollar is moving on average about 100 pips top to bottom. Now look at it in terms of the price action historically all the way back to 94. It's the lowest it has been on record. In fact, if you read a lot of institutional reports, you're hearing about FX volatility being low as a whole. And I'm going to show you how this is just repeating itself over and over and over again. Average volatility, if you were to kind of put this in here, is generally right around here. It's about 229 pips, so almost double where we are now. And keep in mind, when I was trading, when I first started trading, this is back here, 260 a week. So 260 a week, averages probably around 220, 230, and here we are at about 100. We're less than half the traditional average or mean for this particular currency pair. And so this is incredibly important. This means something for you as an FX trader. It changes the way you trade the markets. For those of you who've just started within the last 5 years, this is a completely different market than when I started back in 2000. And we've had massive changes in volatility. We had the 2006 to 08 great financial crisis, and so that created a change in volatility. But when the market changes, volatility is elastic. When the market changes, so does volatility, and that changes how you trade the market. Now you can kind of see a general pattern here that the market kind of decreases in volatility, decreases, and then we have a huge explosion. And then it decreases and decreases and decreases, and then we have an explosion in volatility. And so I think we're headed for that pattern now. I can't say when it's going to happen. I don't think anybody really can. I would probably say late 2019 or in 2020, we're going to have one of these big spikes. And that makes a difference when your average weekly volatility goes from, say, 100 pips to 300 pips, 360 pips. That means something. That has to change the way you trade. It's super important that you're paying attention to volatility as a whole. But just to show you that it's not just happening in this one pair, let's look at several other pairs and go across the gamut here. So going around the horn, pound dollar, another major. Let me put this little line up, not the crosshairs. Bam, so right about here. Where are we at? This is even with Brexit. We're at about 168 pips a week with Brexit happening right now and all the uncertainty around Brexit. And so where's the average per pound? It's probably right about here. Should be about 394 pips a week. And so, we are incredibly low in terms of volatility, almost the all-time lows since 96. Same thing kind of pattern happened again, kind of grinds lower, lower, and the huge explosion of volatility, and then grinds lower, lower, and then boom, a little pop in volatility here. And so I'm expecting this pattern to play itself out again. Again, I don't know when, but again, you're seeing the same pattern, that the volatility is incredibly low. Dollar yen. let's do the same thing. Running through the gamut. 108 pips a week on average. And, you know, this one had a little bit more of a steady increase in volatility. Back in 2000, that was a big move in the yen, way back in the day. And then we had the same thing, grind lower, pop, grind lower, pop. But average for the yen is normally hovering around 220 on a week. We're half that. So, again, low volatility and continuing to decline. You're just seeing this pattern repeat itself over and over and over again. Even dollar max, a pair that normally has a fair amount of volatility to it, even though it's not the all-time lows, it's in the lower third. It's definitely in the lower third, and its average is probably around here, 420 pips a week. And right now we're down 294. So a typically volatile pair, an exotic pair with a lot less liquidity, even that is experiencing depressed volatility. So what does all this mean for you as a trader? What does this mean? Why is this happening? Let's go ahead and jump in. So one of the reasons that the yields, or one of the reasons that the volatility has been decreasing has to do with the yield. Central interest bank rates have been lowering across the board. Very few people are raising, and if they're raising, it's small amounts. When I started trading back in the day, the Australian dollar was hovering around 5+%, and the Kiwi dollar, New Zealand dollar, was around 7.5%. And those are significantly lower than where they are now. British pound was up around 4.5%. You know, all these interest rates were much higher as a whole. The only ones that were low were Swiss franc and Japanese yen. They've been low for quite some time, and they really haven't moved a whole lot. But even the US dollar had a little bit more yield than it is today. All the major G10, G20 countries had much higher yields that mattered. That mattered because investors are looking for yield. When investors are looking for trading positions, particularly people who are holding long-term, they're going to park their money where they can get yield. If the currency is not going to go anywhere on a year-on-year basis, but you can get a positive yield, otherwise known as a carry trade, then you can make money on that. So you kind of have two incomes or two equity curves that are happening simultaneously, kind of like in a stock where you have a dividend. The carry trade is that kind of equivalent. And that makes a difference, especially if you're trading carry positive. For those of you who do not know about carry trade, I'm going to put a link into this article about it. But basically what it is since you're trading currencies, you're trading one currency against the other. That means you're trading also the interest rate that the central bank has for that currency versus the other. So if I'm trading one currency, like in this case, the US dollar versus Mexican peso, Mexico has a much higher interest rate. And so if I'm short the US dollar and I'm long the Mexican peso, then I'm also long their interest yield. And every single day when I hold that position over 5 p.m. New York time, my broker, my bank is going to, or not my bank, but my broker is going to give me a yield differential for that. And so you can even look it up in terms of your broker yield differential if you hold that position per day. Each broker should have a yield table basically per day. So that's what it is. And so since yields are just getting smaller and smaller and smaller and smaller across most G10 countries, then what happens with investors? Do they stay in those low yielding products just like they do in bonds? No, they don't. They go for higher yield. And so they start moving away from more stable G10 countries and start moving to G20, G30, start moving into minors and exotics in the hunt for yield. The upside is that as you get better yield, the downside of that is you get exposed to greater and greater levels of risk because there's lower and lower levels of liquidity as a whole. So what that does is basically it pushes people, as people push into higher yield currencies and countries, the risk kind of increases along with that. And so when there is a huge explosion of volatility and they're caught on the wrong side of the market, that impacts them directly. So we have people, investors, pushing more and more into countries where they can get yield, and then that just depresses movements and volatility in the G10 countries even more. So that's one of the major reasons about it. But for us technical traders, we don't really care. We just need to know that volatility is decreasing as a whole. And so from my experience historically, and I've kind of showed you on the charts, when volatility gets depressed for long periods of time, when the volatility does eventually break, it's usually a massive explosion in volatility. And you can kind of see this here, in 06 to 07, 08, there wasn't much volatility. And then bam, this is a huge spike in volatility in the ATR and the average movements per week basis. And so, and again, you see this here, same thing here, huge spike in volatility. So When volatility gets low, it can only remain that way for so long. And then what happens is eventually once those kind of dams break, you see a huge spike in volatility. So now that I've kind of talked about what's happening with kind of all-time lows or, cyclical lows in volatility, let's talk about what this means for you as traders. So first thing to understand is that if you're a day trader and volatility, if the weekly range is getting smaller and smaller, what does it mean for you? It means you either can go for smaller targets or you have to move into pairs that have higher amounts of volatility. Again, moving into higher yielding currencies and higher risk. So you might have even noticed it, that the targets that, if you've been trading for 5, 6, 7, 10 years, the targets you used to be able to get 5 years ago, they're not as easily achieved right now. You don't get them in the same amount of time. It takes longer to get there. And so if you are a day trader, if you're a Forex day trader, it's super important that you need to understand how volatility is affected by this environment. It means either less opportunities or longer holding times, or you got to move into currencies with higher amounts of volatility. So that's how it's affecting day traders, and I'm one of them. Number two, if you're a swing trader, if you're used to getting, say, let's go back to the euro dollar for a second here. Let's say you are used to targeting 200 pips. Well, guess what? Because volatility is depressing, what that means is you have to hold your trades for longer periods of time now because it takes longer to create the same amount of pip movements. So you're going to have longer holding times as a whole. Whether you are even a day or swing trader, you're going to have longer holding times. So just understand you might have to be a little more patient with your trades. And since we're in summer, that applies even more so because there's less liquidity and general volatility in summers as a whole. So understand you can either reduce your targets or you can go for the same targets, relatively same size targets, but just understand you might have longer holding times. And that's super important to understand as well. Now, with that being said, another thing that you can do to kind of fight back against this process, you have several options. So one option is to increase the number of instruments that you're trading. If you're normally used to getting, a few 100 pip trades, several 500 or several 100 pip trades per week, but that's kind of getting less and less with the volatility down, you can look at more instruments so that you kind of keep the trading volume the same. That's one option to do that, is start looking at other more instruments. The other option is you can start looking at different asset classes, which is something that I've been doing. I've been a multi-asset class trader for a long period of time, but I've gotten really active in day trading the stock market because I can find a lot of volatility and opportunities in that, especially since I'm in California. Early morning for me, I can get the New York Open. I can get some pretty good volatility there on some stocks. And so that's another option. You can look at checking out other asset classes, especially ones that are having good movements. You can look at indices, you can look at commodities, precious metals are really active right now. There's options for you. So spend some time researching other asset classes and, get to know the price action, watch the charts for a couple weeks, maybe a month. And the ones that you really feel like you like and they resonate with you and they move the way you like to move, try starting off with demoing them, get used to them, see how you do with them. And if you perform well with them, then you can look to add that as an instrument and asset class that you trade on a regular basis. So you can still be as active and as frequent as you were before when the markets were more volatile. So that is another option. With that being said, I hope you enjoyed this video. Make sure you smash the like button and also subscribe to the channel. It helps us out a lot with the YouTube algorithm and everything like that, and also really just helps us out as a channel as a whole. And so if you have any also tips or suggestions for volatility, hey, make sure you share that in the comment section as well. What have you done? Have you noticed the volatility changing? Have you noticed that there's less opportunities or that you have to hold things longer? What have you noticed about the changing volatility in the FX market, especially you that have been around for a couple of years, 2, 3, 5 years? You've been around for years now and you've seen those changes over time. How has this impacted your trading? We want to know. So with that being said, I hope you enjoyed this video. I look forward to your comments and questions, and I'll see you in the next one.